It's Brian Preston, the money guy.
Here's the first one. Not creating a proper estate plan.
Oh, that's a huge one, yeah.
Now, you guys know, anybody who reaches out to us and calls us and says, hey, can you give me some guidance on what's going on? The first thing we'll ask you is, do you have children? As soon as we ask you that question, then what we're trying to figure out is, if you leave this earth tomorrow, is your family going to be okay?
Right.
Have you, do you have a will that will tell who's left behind, your relatives as well as the state and everybody else, that this is who I want to take care of my children. This is who I want to administer my assets after I'm not here to represent myself anymore. Do you have life insurance that will cover and replace your income? We just did a whole podcast series on good decision making with insurance. Go check it out if you don't know if you have enough life insurance for your family. And then healthcare directives. Now let's get into some stories.
Okay.
Healthcare directives are those type of decisions that, you give while you're alive, while you're healthy and able-minded, to what you want done to you and when you can't answer for yourself. Because what happens if you get into a situation where they need to put a breathing tube in or other things? How long should that be in? These are horrible, horrible decisions that you have to make. But I can tell you, through my own family, my father-in-law passed away just a few years ago.
Right.
And he had a minor surgery that unfortunately there's some complications that led to him. They had to put him on a breathing tube. They had to do some other things to keep him on support.
Sure.
And so unfortunately he was unable to communicate anymore for what his wishes were. And we got to the point where my mother-in-law had to make some hard decisions.
Right.
And I could tell you it was painful to experience that, but it was also painful to watch her having to go through it. Fortunately, they had healthcare directives. Mm-hmm. So she was able to go read what he wanted done to him. Notice, okay, we've gone past how long he wanted to experience these life prolongment exercises. And she had the peace of mind knowing that this is what he would have wanted.
Sure.
Now, if we would not have had those healthcare directives, I'm not so sure that she would have the peace of mind after my father-in-law passed away.
And so the reason we wanted to share this one first, and the reason that we think it's scary, I mean, obviously dealing with death is scary, and thinking about, getting sick or having to make those decisions is scary. But most of financial planning is thinking about things that you have some control over, how long you want to work, how much you want to save, what you want to invest in. The reason this is a really scary thing to not have in place is you don't get to control when you need that will to take place, when those healthcare directives are going to matter, when that life insurance is going to be the lifeblood of your family. And so that's why it's scary. If you don't have those in place, you really are kind of flying naked.
The other one we have, the next one, is not having cash reserves. I mean, this is one, guys, there's all kind of unexpected emergencies that can occur. I think I've mentioned on every other episode, I don't know why I'm worried about hot water heaters exploding, but I mentioned that on every episode where we talk about cash reserves.
Right.
But it really could be a car accident. A lot of health insurance now is high deductible plans where you have to have some cash reserves. So in case you have to make that deductible or out of pocket maximums. So you want to make sure you have enough money for emergencies, repairs, as well as just opportunity money. Having cash reserves is not only just to cover the bad things. It can be for opportunities. So don't have those experiences where you don't have cash reserves. The stories we have with that is that we have people, it's not uncommon that we'll have people reach out to us that have failures with businesses and a lot of other things where they were not prepared. We'll go do 401k presentations where people will have to take 401k loans and do other things. And it's usually because they didn't keep enough cash reserves to get them through those dark periods and those bad things that could occur.
Right.
So make sure you're keeping enough cash reserves and liquidity so nothing derails you. The other thing, here's one we did another podcast on specifically. So all you have to do is go join the Smart Money Club. Go to moneyguy.com. Give us your email address. You can pull up all of our archives all the way back to 2006 when we started doing this, because we don't want you. This is the tip. Don't live a lie. Don't have zombie debt that's sucking the life and happiness by draining your sources and limiting your choices and opportunities in life. We did an entire show on zombie debt. And that's one of those things. And what am I talking about here? Big mortgages.
Yep.
I'm talking about tons of credit card debt. I'm talking about running up student loans for a major that might not even be able to pay off.
Sure.
Because of the earning potential.
I feel like that's one, and I don't know if maybe this is. I think it is a bad thing. I feel like that's one we see a lot. We see a lot of young students reaching out to us, or parents of students reaching out to us, saying, hey, my child has, $70, $80, $90, $100,000 of student loan debt. And then our immediate first question, okay, well, what did they study or what are they going to do? And it turns out to be something that's going to make it very inhibitive to get that debt paid off.
So let's give some tips, because not only do we want to give you the advice or things to be aware of, let's talk to you about how do you set some rules or have some good rules of thumbs to understand where you should be. Let's talk about student loans first. Here's the thing about student loans: if you're looking for guidance, I would try to come out of college with student loan debt that was at least matched or less than that first year of income that you could make. Now, there are exceptions to the rule. Obviously, if you're an attorney or an engineer and you're going to see your income, maybe this pace starts low coming out of college, but then it accelerates very quickly as you earn your expertise. Those are exceptions. But if you are one of those people that's coming out and you're doing your major is going to create an income in your first year out of $25,000 or $30,000, and you're probably not going to get huge step ups from there. You might want to make sure that your student loan debt stays below that threshold. The other thing I want to talk about is tons of credit card debt. Look, credit cards in general are a tool, but they're a tool no different than a knife or a very sharp instrument that you have to be very careful of using. You have to very much respect tools like credit card debt. And that's why we recommend to do it right, pay it off monthly. Take advantage of some of those planning tools and the insurance and the extra protection that they provide for you, but also make sure that you're paying off monthly. And then big mortgage. Look, I recognize that a lot of people who have this zombie debt are trying to create a trophy experience where you look very good, that live that lie out there to people who are looking outside, looking in, and get that fulfillment from the fact that, oh man, they think I'm successful.
Right.
But the problem is that it is a lie. And it's very much, that's why I call it zombie debt, is because it's going to suck the life out of your choices, out of what you can actually do to enjoy your life. So think about debt. I know the standard is about 28%, counting on principal and interest as well as taxes and insurance.
And that's for your housing debt,
On
right?
your housing debt. But I would encourage you to push that number down to 25% so you have a little more latitude to enjoy life a little bit and actually even think about building assets to save for retirement in the future.
So I'm going to rephrase what you just said. If you're looking for a rule of thumb, add up the total amount that you pay for housing right now. So principal, interest, and a mortgage, or what you're paying in rent, maybe throw the utilities in there as well. And you want that to be less than 25% of your total gross income. That's the easy math to do to figure it out.
That is correct. The next one, buying investments you don't understand.
Oh, man, I feel like we see this one a lot too.
We do, usually with prospects. They come to us. Here's the first one I'll pick on. Specific types of annuities.
Okay.
And I'm not saying all annuities are bad, but here's something that I want you to be aware of. A lot of annuities will control your ability to vote with your feet. And what I mean by that is you get into a product that you don't like, you might be trapped there for 10 to 12 years. They control your behavior by surrender periods, lockup periods, and other deferred sales charges and other things like that. So be aware of that.
Well, that sounds bad. So why would anybody buy an annuity then? I mean, how are these things getting sold so often?
Well, some of them are sold to you because they have cool features. I'll give you an example. Equity index annuities. I hear these things advertised on talk radio all the time, and they brag to you to be the panacea of you can get stock market returns with no risk.
See, whenever
How's
I
that
hear no
possible?
risk, I always get a little nervous.
Yeah, what they do is they lock up your behavior by that 7 to 10 to 12 year deferral period. The other thing they do is they cap your performance. If you have a year where the stock market is making 15, 20, 30% like we saw in 2013, you don't get all that. Usually there's performance caps that will cap you at 7, 8%, and then the insurance company gets to keep above and beyond. So make sure you understand what's going on. Don't buy investments you don't understand.
And so I'm correct in this math. We talk about all the time, Brian, that markets statistically are up 8 out of 10 years, right? I mean, that's sort of loose, but 8 out of 10 years they're up. So the way that they're able to guarantee that you don't lose any money is in those 8 out of 10 years the market's up, they're getting the majority of that upside and you're only participating in a piece of it.
Yeah, they get the upside, and then they know that you're not going to, because you're thinking, well, it's all right if I buy right before a market crashes. I'll get them and then I'll move it over to a cheap index fund. No. That's where that deferred sales charge or that surrender fees and that lockup period is going to control your behavior. So they win even if you do get them on the beginning of the great timing of the investment. The other thing is private investments. We have we have some show notes here. We have 2 examples and 2 scary stories in the fact that one, their advisor put them in all these private placements that just like the annuities locked up their ability to vote with their feet and leave. But then these things are complex. Here's why I don't love some of the complex private investments. If you know you're going to get a K1, a lot of times these K1s don't come in by April 15th. Right. So you better get excited about doing extensions and your tax preparer always extending your tax return. You better get excited about the fact that you've got to find some place to custody or hold these assets, and they usually have custodial fees, like $250, and then they require annual audit statements, and there's all these hoops that you have to jump through. And then there's also the fact that a lot of private placements are not as efficient. They don't have to, there's a reason they make you be a accredited investor, meaning you have a certain level of income, a certain level of assets to prove, hey, you don't have to, the government's not going to give you all the protection that they require for the average investor because you're what's known as an accredited investor. You supposedly are sophisticated enough that you don't need all that basic protection. So just be careful. There are some things with private placements. Now there's some really good ones. I don't want to, but I just say that there are a lot of them that are structured to be sexy for the sake of selling you the product versus actually the material being a better product that's going to get you a better rate of return. I'm reminded of what Warren always says is that, the 2 things that you need to kind of master to be a successful investor are fear and greed. And it's so interesting that the 2 things that we just mentioned, annuities play on the fear, and then I think the private placements play on the greed. So great point. If you find yourself on one end of that spectrum, do sort of an introspective look and say, is this the right thing for me, or am I falling prey to those 2 emotions? The next one I want to jump into on scary stories is making sure you have an understanding of things that you can and cannot control with your family and the protections and things you can do to protect yourself. And the fact that we just did that episode on insurance. Yeah. So I'd recommend people still go back and look at that because one of the things that's often overlooked is umbrella insurance. Umbrella insurance is that insurance that sits on top of your automobile policy as well as your homeowner policy. And we had a case where one of our clients, their child did something inappropriate and threw a rock at a school bus, and the rock hit a child, and there was some litigation, some medical and some other things that occurred. It was that umbrella insurance that kind of came in and saved the day. So that's one of the things, even though you might be the most responsible person in the world, there still could be some risk from family members or somebody coming to your house to do repair work, work on your roof, slips and hurts themselves. Make sure you understand how you can protect yourself, and that's why we have episodes on insurance. That's why we talk about umbrella insurance and other things you can do just to make sure you insure away those risks. 15 seconds, Brian. Who needs umbrella insurance? I think anybody who has built up assets. You have a target on your back if you got in a car accident, if somebody's damaged. So I think the majority of, especially if you're listening to a podcast like the Money Guy Show, most of you need umbrella insurance. And you're going to like the fact when you call your property and casualty agent, it's pretty cheap. It's not going to cost a ton of money. And I typically recommend getting as much umbrella insurance as your net worth. Okay. So if you're worth $1 million, get $1 million of umbrella insurance and you should be pretty protected. And that's going to cost just a few $100s a year. Yep. It's not a ton of money. Let's talk about taking, this is the last one on the negatives to be aware of, the scary stories. Taking unnecessary risk after you've won the game. Oh, yeah. Guys, I'll tell you, I'll go way back when I started this company back in around 2003, 2004. I had a couple who came to me who were quickly approaching retirement, and they went and talked to another financial advisor. And that financial advisor, they had a completely paid for house, and that financial advisor approached them and he said, you know what you need to do. You need to go take a mortgage out on your house and put it in the stock market. And this is 2004, 2005, somewhere in there, right as I started this company. And, analytically, they might have a point because you'd already said, hey, markets are up 8 out of 10 years. Sure. What could go wrong? Here's what could go wrong. As you guys age, as you get close to retirement, you really do get to a point where can you afford to take additional risk that could derail the win that you've already had? It's called risk capacity. You might not have the years left to let your portfolio recover. So why take on that additional risk? I mean, that's what most of us are working and saving and building financial independence, that army of dollar bills, so that we can pull back and do the things that we want to bring fulfillment. Don't go and take unnecessary risk by getting too aggressive. We've also seen this case, Bo, with this happened in the last year.
Yep, that's right.
Is we had somebody, it's one of your clients. Why don't you share what happened?
Yeah, so what happened is just like this client was actually already retired, already in retirement, or at least pseudo-retirement. Same thing, had a house that was paid off, but they were looking to move, and their plan was they wanted to take the equity in the current house and roll it into the next house. They had a paid-off new house. Well, again, before they met with us, they had an advisor that they were speaking with, and that advisor said, "Yeah, you know what you ought to do? I get that the stock market is risky, stock market is aggressive, but with this new house, you should take out a mortgage and let's go buy a bunch of insurance products. Because now you're not taking stock market risk, and we're all going to die, so the insurance is going to pay, and it's going to be a great thing for your lineage." And we had to kind of walk them through the pitfalls and the dangers associated with that. And the best thing for their situation was to not have to worry about having a mortgage payment, not have to worry about a note, because they were already at that financial independence point. And so, again, it's that fear and greed. I think that advisor was probably playing on the greed of wanting to have more money to leave behind, when really it could have sacrificed their current livelihood.
Yeah. And talking about fear and greed, what do you think was motivating that decision to recommend that? That's something else to take into account.
Absolutely.
But in the last one, before we get to the scary decisions that are scary stories that are positive, is being too aggressive with your portfolio. We had it's now a client. It's one of the parents of one of our very long-term clients. Yep. The parent had an advisor who, I think they bought the top funds that Kiplinger or probably whatever money, choose any money magazine from the 90s,
right,
where the issue where they say the best funds of 1996.
Yeah, yep.
Those magazines are out there. This advisor went and bought this client all those top mutual funds, and then I think just forgot about this client. Mm-hmm. And this client now was in their 80s.
Yep.
We went through the dot-com bubble. Mm-hmm. We went through the Great Recession of 2008. And never changed the portfolio. All these funds that were the high flyers back in the 90s were now one-star funds according to Morningstar. It was criminal. I mean, this poor person who was in their 80s lost over 40% in 2008.
That's right.
And this is a person that should be thinking about preservation of capital. So don't take too much risk after you've won the game. Right. This is easy, and that's why just make sure you're keeping up with that, because that's a scary, scary thing to actually have the hard part done. You saved the money. You put the resources to work for you, but you didn't update the plan to make it appropriate for where you were in your stage of life of where you should be in goals.